In this podcast, we will learn what strategies Warren Buffett uses to pick his stocks and shares.
It's fascinating because Buffett's approach, it's not just about the numbers. He's not after those quick returns. He's looking for companies he can hold on to long term.
He compared his investing style to baseball. So it's about being really selective, patient, right? Not just jumping at every single opportunity. So how does he actually find these sweet spot businesses?
You know, like think of companies like Apple or Coca-Cola. They've got that something special that keeps people coming back for more.
Hello there. You are watching Plenty Passive. Welcome and enjoy.
All right, let's dive into the mind of Warren Buffett today and unpack his investment strategy. We've got some awesome clips from an interview where he really breaks it down.
You know, it's fascinating because Buffett's approach, it's not just about the numbers. He's not after those quick returns. He's looking for companies he can hold on to long term. That's what he really believes leads to those incredible returns.
Yeah, and he actually used a really cool analogy in this interview. He compared his investing style to baseball.
Oh, right. He talked about waiting for that perfect pitch. You know, like the sweet spot, that business that's so fundamentally sound that he'd be totally confident betting on its success for years to come.
So it's about being really selective, patient, right? Not just jumping at every single opportunity. So how does he actually find these sweet spot businesses?
Well, he really focuses on companies with a strong competitive advantage, something that makes them stand out, you know, something that makes them resistant to competition. Think of it like a moat around a castle.
Okay, that's a great visual. So a strong moat protects a business from being overtaken, right?
Exactly. And Buffett looks for those wide, deep moats, the ones that are going to last. Could be a powerful brand, maybe a unique technology, a really loyal customer base. You know, like think of companies like Apple or Coca-Cola. They've got that something special that keeps people coming back for more.
Yeah, and See's Candies is a perfect example of that, right?
Absolutely. He bought See's Candies back in 1972. Paid $25 million for it. And his bet was that people would still be craving those chocolates decades later.
And he was right. I mean, they're bringing in almost $2 billion a year now for Berkshire Hathaway. That's kind of amazing. It really shows his ability to spot those companies with staying power.
Totally. And it highlights how important it is to think long term. Buffett's not trying to time the market or chase every trend. He's playing that long game. And that takes a different mindset.
Right. So it's not just about what a company is doing today. It's about what they'll be doing 5, 10, 20 years down the line.
Exactly. He's looking for businesses with enduring value. But it's not just about the product or service. Buffett also talks about the importance of the trusted manager.
So it's not just numbers. It's about the people running the show, too.
That's it. He wants to see strong leadership, teams that line up with his values, and have a history of making smart decisions. Remember the sweet spot analogy. Well, great managers, they're a huge part of that perfect pitch.
So he's really looking for those leaders that fit in with Berkshire Hathaway. What does that actually mean?
Well, Berkshire Hathaway, they're known for their decentralized structure. Buffett's not really into micromanaging. He finds leaders who are already doing great and gives them the freedom to keep doing their thing.
Really trusts the process then and the people he's chosen.
Oh, absolutely. But goes even deeper than that. He looks for what he calls owner-operators. These are people who treat the business like it's their own, passionate about seeing it succeed, committed to that long-term growth.
So it's more than just financial skills. It's about finding people who share his vision, his values.
You got it. Buffett's not interested in those fast profits. He's playing the long game, remember? And that needs a certain type of leader, someone who's in it for the long haul. And speaking of the long game, it's interesting, both Buffett and his partner, Charlie Munger, they're really open about the mistakes they've made in investing.
Wait, even Warren Buffett makes mistakes. That's, I don't know, kind of comforting to hear. What kind of things did they stumble on?
Well, they both admitted that early on, they tried to fix businesses that were already struggling, tried to be like turnaround specialists.
Did it work? Did they manage to turn them around?
Not really. They'll be the first to tell you those early attempts were failures. But they always emphasized the lessons they learned from those experiences. They were really valuable.
So what was the main takeaway from those oops moments, what they learned?
Well, it really solidified their belief that it's much better to find a fundamentally strong business that's already on the right path, instead of trying to rescue one that's failing.
Like, it's better to hop on a ship that's already got the wind in its sails than to try to patch up one that's sinking, right?
Exactly. Those early missteps, they were like paying tuition for a top-notch investing education. They learned that it's often smarter to buy a fantastic business at a decent price rather than trying to get a so-so business for a steal and hoping to fix it up.
That's a really good point. It's tempting to always look for a bargain, but sometimes it makes more sense to pay a bit more for a company that's already high quality, one with a track record.
Right. It all comes back to understanding what you're buying and why. Buffett doesn't just glance at a company's finances. He digs deeper, tries to really grasp their competitive situation, their long-term potential, and of course the people at the top.
It's like they say, right, invest in what you understand. But Buffett, he takes that even further, I think. Invests in what he understands and what he believes in for the long run.
Yeah, for sure. He always stresses that. A strong business, fair price. Way better than a mediocre business at a bargain price.
Yeah.
Even if it means, waiting for the right opportunity. He even said, he might have thought twice about See's candies if the price had been way higher. And that was a huge win for him.
It's true. Sometimes you got to pay a little more for quality, for that lasting competitive advantage. And speaking of, how do you navigate those decisions, especially in today's market? Everything's changing so fast.
That's where it gets really interesting. Remember that moat idea? Protecting a business. In a world where, like you said, everything's constantly being disrupted, figuring out those really durable advantages, the ones that last, it's more important than ever. What worked in the past might not work tomorrow.
So how do we spot those companies? The ones that are built to last? The ones that'll still be around decades from now?
That's the million-dollar question, right? You got to look beyond just what's on the surface, beyond the current trends. You got to understand what creates that lasting success. What makes these companies different? Is it their knack for innovation, their ability to adapt as consumer behavior changes? Maybe is their dedication to building a brand that, resonates with generation after generation? It's something every investor has to ask, whether you're just starting out or you're a seasoned pro.
So it's not enough to just see a company's current moat. You got to figure out if it's wide enough, deep enough, to handle all that competition in a world that's constantly changing. That's what sets Buffett apart, I think, seeing those truly enduring businesses, something for all of us to think about.